The difference between trading and investing. Trading and investing are two terms which are often used interchangeably. While the definition of both is similar, there are some key differences that make it important to understand the difference. Trading is a process of buying and selling assets within a short period of time, typically hours or days. Investors, on the other hand, will buy and hold an asset for much longer periods, sometimes years. Investing is a process of buying assets with the goal of achieving long-term gains by utilizing the asset's income. This includes buying shares, bonds, stocks, and real estate. Trading is also done in the form of derivatives, such as futures, options, and swap contracts. Investing is often thought of as a complex process with a lot of risk involved. This is because investing takes time and requires diversification for the long-term holding period. Trading, on the other hand, involves less risk because it typically only happens over shorter periods and does not involve the same long-term investment horizon. For example, a day trader may buy and sell in the same day, whereas a long-term investor may put money into an investment without regard to when they will be able to retrieve it. In general, those with a trading mindset tend to have more success than those who have an investing mindset, as they are more likely to take the appropriate actions and make the necessary adjustments to succeed. For some traders, the trading mindset is a lifetime commitment that is accompanied by a passion for the market and an intense desire for material wealth. In contrast, those with an investing mindset value patience over speed, value long-term sustainability above short-term gains, and seek out investments with high levels of value. How do the two mindsets impact your investing? The two mindsets are often in conflict, and those with an investing mindset will typically make the most money over time. Those with a spender mindset typically enjoy spending money in the short term, but are unlikely to end up wealthy or even financially secure by their own accord. There are different versions of the mindset, and researchers have identified a few that are more likely to be successful. 1. The value investor. This mindset is characterized by an analytical approach to investing where they focus on finding undervalued assets with strong fundamentals. They also have a disciplined approach, limiting their holdings to what has been proven to work over long periods of time. The contrarian. This mindset is characterized by taking an opposite approach of the majority, often purchasing assets that are underperforming or on the decline and betting on them to become more valuable in the future. Day trader. This is an individual who makes trades in one direction without planning to hold the asset for more than one day. These different mindsets can be combined to form a more individualized strategy. For example, a value investor might also take short-term positions in the stock market. That may increase the odds of success for this individual investor's strategy. A value investor may also invest in a passive index or ETF that tracks the performance of a broad range of stocks and other securities. In other words, a value investor is focused on finding stocks that are selling for less than their intrinsic value. New Money Millionaires wishes you the best. Like, subscribe, and share.